Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, good day, everyone. It's Liam Garman here, Managing Editor of Real Estate, back with another episode of the Smart Property Investment Show. And you know that I love having experts here in the studio. I don't buy the conference Zoom calls anymore. We used to do that here, but you can't get the great human interactions as you do in the studio because I have the world's best job, which is speaking to some of Australia's smartest property investors and people that work in the property business. And today's no different. I'm joined by the one and only Godfrey Dinh, founder and CEO of Futurerent. Godfrey, mate, welcome to the podcast.
Thank you, Liam. Really great to be here.
And it's we had a coffee before this, chatting about all the amazing work that you're doing at Futurerent. For our listeners that are unsure, that haven't heard or engaged with Futurerent in the past, talk to us about what you do.
Yeah, so in simple terms, Futurerent is really the easiest way for investors to unlock cash from their investment property. So Futurerent is mainly helping people unlock money to buy more property, to finance renovations, to really often as well just access liquidity when they need to access liquidity. Property is one of those things where really you need to maximize your time in the game. And sometimes that means, being able to access your money when you need it without having to go with the complexities of dealing with the banks.
What is, say, the difference if you're accessing liquidity versus, say, going to a broker and refinancing and pulling out equity? How does it differ?
Yeah, so we really see it as they're two fundamentally different things, right? Your mortgage, that's your long-term debt strategy, right? That's the loan that you have for 25 to 30 years, right? And to buy property, really you need two parts to it. You have your debt and you have your equity. And you can't really move forward and you can't grow without both of those things, right? So I guess a cash out refinance until Futurerent, that's conventionally how investors have accessed capital. But in reality, it's hugely inefficient from a time perspective and it's hugely expensive. Because when you look at, say, accessing $100,000 in terms of topping up your mortgage, you're probably going to pay over $100,000 worth of interest over the life of that loan.
Not to mention the refinancing costs as well that you're going to be incurring on top, or depending on how far you draw it down, incurring lenders' mortgage insurance, things like that can be pretty costly.
Exactly. Often if you're making decisions based on your short to medium-term needs, and you're changing your long-term strategy, that's not necessarily going to be a good idea, right? So we really, I guess we do a property-based approval where we don't look into or dive into anyone's personal finances. Really, we look at what the property's worth, what the existing loan is on the property, and we let people cash out basically half the equity that they've got in the property. And they do it, without any of the paperwork that the banks require.
So how does it work? Do you have investors that are backing you and the collateral's the house, or how does the mechanism work?
Yeah, so the mechanism is we enter into a type of lease with the owner of the property. Now, it doesn't matter whether there's obviously most tenancies in Australia are month to month or periodic, right? It doesn't require there to be a certain term in place. Essentially, we give the owner a rental prepayment. We have this thing called a concurrent lease, which exists at the same time as the residential lease. And then we're entitled to a fixed amount of rent back from the property. So the owner knows exactly what it's going to cost them, and they get that rental prepayment upfront. Now, most people, they have a 3-year term. So essentially, whatever they access, so they can get up to $100,000 per property that they have, and that'll get recouped over a 3-year term from a portion of the rent. So that way they can essentially they can get money up front and they can still continue to receive an ongoing cash flow from the property to meet their sort of expenses. And, when you talk about investors who have 3, 4, 5 properties, often people are accessing, $300,000 to $500,000 on their portfolio.
So what kind of results are your clients seeing at the moment?
Yeah, so I guess I'll talk about two things. So, at a high level, for every property that one of our clients has, they're making about $50,000 a year in capital growth, right? And so on average, our clients have bought a place for say $500,000. Say 6 years ago, that's now worth maybe $800,000. Over the next 5-6 years, it's probably going to be worth 1.2 million, right? And they're in the game of accumulating assets and accumulating exposure to the market that's going to grow with the benefit of inflation, and give them an even better return on their equity, which we can sort of get into later. But at a high level, that's sort of what we're doing. I think, to give a couple of examples, though, that are some terrific examples, but by no means necessary. And I think a lot of people get caught up often on thinking that they need to do incredible things or they need to be incredibly inventive in order to really make money in property. And I think that's one of the biggest myths, right? The reality is, as long as you buy good quality assets, and you treat and I can talk more about the philosophy that we sort of see people approaching, but as long as you're buying good quality assets, you're going to make that $50,000 for every property that you have if you're in that ballpark of quantum or value. But more specifically, like some examples, like we've got a client, for instance, Stephen, who came to us. He had 2 investment properties. He was stuck at 2 properties. He had a unit in Darlinghurst and a house on the Central Coast in Budgewoi. And so his house was original condition, right? So it was probably built 20 years ago, rented for sort of $700 a week. And that market has really lifted significantly for the properties that are positioned to the right end of the market there, right? So he spent about $80,000 renovating, just cosmetic stuff, renovating that property, and was able to lift the rent from $700 to $900 a week. So that's like a 12-13% return on investment because he's getting an additional $200 a week, so $10,000 a year on an $80,000 spend, right? That's lifted his borrowing capacity overall, and then he's actually then used Futurerent again on that property for a deposit to buy his next property, right? So he's managed to tap into one property, renovate, another property, lift the rent, and then use Futurerent again as the deposit to go to his third property, right? So go from a situation where he's stuck to actually growing and getting more out of his property portfolio.
So it's at its core, it's a key for scalability. And this is something, and do correct me if I'm wrong, but just before we started pressing record on this podcast, you and I went out for a coffee and we were talking about, it's like 80-90% of property investors in Australia are in that 1 to 2 property bracket, depending on things like serviceability, depending on things like how negatively geared you are. There are going to be significant hurdles there in getting to properties 3, 4, 5. So this is essentially a mechanism through which people can unlock that scalability and continue their property journey.
Absolutely. Like you need money to make money in property, right? And a lot of people, most property investors, they're asset rich, right? But they might not have, or they might not want to invest their own personal cash in their property
liquidity
portfolio,
poor,
right?
and that's a really good example of the person that you gave before, and it's something that we speak to a lot in this podcast. It's a really recurring theme where people overshoot, usually on their PPOR, where they overshoot on their PPOR, which precludes them in the future from scaling further. And the best example that I can give is, when my wife and I almost walked into this trap, which was this example I give all the time because it was only probably 4 years ago now, where we were looking at a great place, solid place in central Brisbane, and that would have capped us off with our PPOR. The 2 of them, we could not have gone further. That would have precluded us from any future growth. The way that people are structuring their portfolios and shooting so high with their first investment property or their owner occupier, leaves them with such little margin to buy properties 2, 3, 4. And that is, in the long run, you've got a great place for now, but it's stopping your future growth.
Yeah. Well, exactly right. Like you need to balance, I guess, your income with, and you know, that's your personal and your property income with your overall property goals, right? And what's going to be most advantageous to meeting your goals, whatever your goals are.
Yeah. And you mentioned before about the philosophy that a lot of your clients have and the philosophy of how you approach investing. Can you talk us through that?
Yeah. So I guess we've looked across our and this is kind of based on two things. It's based on, I guess, some of my own experiences as an investor, and also then looking across, you know, the thousands of investors we talk to every year. And really the ones that are doing it right, it's not rocket science. And it's I think to summarize at a high level, what it is that they really do well is, I think that a lot of investors, they actually think that they need to do too much, and they actually think that they need to be super active, right? But the reality is that building a good passive property portfolio, now you're never going to make passive income from your property portfolio, right? Your property portfolio is probably going to burn cash, right? But if you have a relatively passive strategy where your strategy is, I'm going to buy property, I'm going to accumulate assets, and I'm going to try to get a large portfolio of assets that are going to make me more in capital growth every year, right? Then that is, over the long term, what's going to make you real wealth, right? Now, we sort of summarize, and we have an ebook actually on our website at futurerent.com.au/SPI for your listeners. And it talks about the power method, which basically outlines the 5 steps that we see are really the essential ingredients to building a proper property portfolio. And we can talk about some of the different aspects.
No,
but,
talk to us. Go through it now,
yeah.
because and this is something that, you know, setting the strategy, setting the philosophy is incredibly important, because and in just a moment I'm going to ask you a few questions on that, especially with some of the different schools of thought out there, and some school of thought saying that, you know, once you get to a certain level, start consolidating so you can have a passive income, and then there's going to be your school of thought. Before we get there, if you could talk us through these 5 themes, how are we describing them?
Yeah, so I guess they're 5 key principles, right? So the first is like just the property itself, buying property. So P for potential, right? So if you're buying property that has potential to increase, where you're not buying it necessarily you might be buying the worst house on the best street. You might be buying in an area which is gentrifying, which is going through some change. You might be buying a property that you know in the future could benefit from, it might be on a large lot and you could carve off part of the lot and, do a duplex, right? So buying property that has potential is going to give you a bit of an extra boost, but you don't have to reinvent the wheel or do anything too crazy there. You just need to buy good quality property that's got potential to appreciate in value. Where you say, I'm buying it for 800 today, I can see it being worth 1.1 5 years from now, right? So that's the first one. The next one is oxygen, which is actually about seeing your income really as actually just oxygen to drive your borrowing capacity and your purchasing power, and seeing your income on a unified basis where you're looking at your personal and your property income and trying to figure out, okay, well, how can I make the income that I need so that I can move on to property number 3 and property number 4. So, for example, we have a client who does a lot of granny flats. So he buys houses in southwest Sydney where he can essentially, they're on a big enough block of land and the access is right. He can build a granny flat for a couple of $100,000 and he can get an extra $500 a week in rental income, right? And that's massively then that's oxygen to continue growing his property portfolio.
And number 3?
So W is really wealth creation, right? And looking at your property purely as a wealth creation tool for what it is and understanding what that actually means. Now, I think there's a lot of misconceptions where people think they're going to buy property for passive income. It doesn't work like that, right? Anyone who's owned a lot of...
People are cracking their knuckles in the comment section now. Yeah.
It just doesn't. Like, property does not yield well enough to the point where you're going to generate passive income. Where you're going to make your money in property is through capital growth, right? And if you understand that and you look at the components of that, where really property is just a vehicle and you got debt and you got equity, right? And you look at, okay, well, how can I use the machine to create more equity and create more net assets, right? Which is kind of essentially the fourth one, which is equity.
Yep.
And looking at your return on equity, right?
And is R number 5 return?
R is actually recycle.
Oh,
Yep.
well, that's even better. Yeah.
Yep.
That seems better.
Yep.
Yeah. No, but back to equity.
So equity, I mean, look, in really simple terms, say you buy a $500,000 place and you've got $100,000 in equity. Now, if that property grows by 5% a year in value, $25,000, it's appreciated each year before compounding, and you've only got $100,000 in equity there. So you're making $25,000 on your $100,000 in equity. So you're making a 25% return on equity.
Yes.
Right.
Yep.
Now, that is actually really good, right? In 3 years, at that return, you'll double your equity, right? So if you're going from $100,000 in equity to $200,000 in equity in 3 years, I mean, you don't actually need to double your money that many times to get to, say, $5-10 million, right? Yeah. But where people fall short is the ratios become out of whack, right? So essentially, they instead of them maintaining leverage that is going to allow them to have, so instead of them going, great, I've got $200,000 in equity, I'm going to buy $1 million worth of property instead of just having this $500,000 asset, they just stay with that $500,000 asset, right? But if they go, you know what, great, I got an extra $100,000 in equity, I'm going to buy another property for another $500,000. So suddenly I got $1 million portfolio. I'm making 5% now on $1 million from capital growth. I'm making $50,000 a year, right? And it starts to compound. It starts to snowball, right?
So, and that's interesting. Now, do tell me if this doesn't make sense, right? But it's something that I've been dwelling on a lot because you have that I suppose it's a very often considered thing in property where it's what the rising tide raises all ships. So if you're looking to scale, say your owner occupier, and you're looking to, well, I've bought my apartment, I've paid a lot of it down. Now I'm going to go to the house. I'm going to go to my beginner house, and then I'm going to move on to my forever home where I'm going to have kids and white picket fence and whatever. But then the argument would be that, well, the growth on the house has been just as big as your growth on your apartment from which you've scaled from. So realistically, you're not necessarily going to be getting closer to that end goal because the debt that you're going to be acquiring on that next step is going to be so much bigger. Your leverage is going to be so much bigger. So instead of rolling it in to the one asset, you're suggesting have your eggs in many different baskets to accumulate multiple assets to leverage the growth on all the assets.
Well, the benefit about having slightly more property in your investment portfolio is that investment portfolio is generating an income, which is purely the oxygen that can support the borrowing capacity that can give you a bigger asset base, right? So if you can afford a bigger asset base, then just that 5 to 10% a year in capital growth each year is going to be making you larger gains from a quantum perspective. So that, instead of having 500,000, you've got $1 million worth of assets. That same growth rate is giving you double the dollar earn in terms of you earning 50,000 a year then instead of say 25,000 in capital growth, right? So yeah, it's sort of like in that example where generally people have, say, have one unit and they've moved on to a home. I mean, the best thing they can do is keep that unit, buy the house, and then as soon as they're able to, buy another investment property. But the worst thing they can do is sell that investment property
to move up.
Yeah.
And rinse and repeat, recycle.
Exactly. It's sort of we see, the best investors are actually very passive from the sense that they never sell, right? So they're very passive from that perspective, and they're basically just buying and accumulating assets, but they're ruthless about recycling their capital, right? So that they can buy, and I basically mean pulling out the equity that they've got in their properties, so they can buy more properties and continue to grow and continue to expand. It's sort of like you need to hold two things in your head at the same time, where you need to be ultra active in relation to how you think about your debt and how you think about your equity. You need to be ultra passive in terms of, you know what, I need to be patient, I need to sit, right? And I need to try to achieve the same outcome that I might economically through selling, but how can I just get the equity out of the property, not pay tax, not pay agents, not pay all that sort of stuff, and reduce the friction costs to a longer period of time from a holding perspective.
Now, there's going to be some people listening to this podcast going to be sharpening their knives for you, Godfrey. I can guarantee it, because I think, my podcast guests are usually 50-50, right? Like, you do have a lot of people that have that buy and hold longer term view, but you do have probably about half our guests saying, I'll sub something in and out. If I've bought in a higher growth area and the growth has come, it's been realized, I will then sell and move on to a new growth area. What would you say? What would be your critical feedback on that philosophy, on that strategy?
Yeah. So I think often the problem with that is that property will generally be very, very flat for a very, very long time. And then you'll get most of the gains concentrated in just a couple of white hot years, right? And so you will often end up missing out on those gains, and you've already paid the friction costs, you've already paid the stamp duty, you've already paid all of these things. If you've bought property that from an income perspective, it's generating you enough of an income where you're, looking at your holding costs on a net basis and saying, you know what, is it still worth it? I mean, I think that people often they forget just how significant that return is on their equity, even if they're getting 3%. They might be looking over the hill and saying, somewhere else I'm going to get 10, 20%, right? But that might be too late, right? It might, it's like, for instance, Melbourne now. Like there's, Melbourne's been flat for a long time, but it's probably really great value, right? If you look at where it is on the property clock, there's a lot of upside there. You can see that, like, with continued immigration, with just general housing affordability and the number of people that need to still enter the market and buy their first home, and not just overseas migration but interstate migration, right? There's and
I think the other thing that we overlook with that is the arbitrage factor, which is that if you've got money and you're looking to buy properties at store value, and you now look across to Perth, where it's gone up 30%, or Adelaide, where it's gone up 35%, Brisbane, double your return over 5-10 years, people will be moving their money from market to market to find the next best return. And if you're looking at suburbs in Geelong, 40, 50 minutes from Melbourne, and you've still got a 4 in front of it, whereas a comparable area in any of the other major cities now have a 6, a 7, in Sydney, a 1. Money's going to be moving from market to market to find the next best place, which is, to your point about it's flat until it's not flat, and they'll go flat again until it's not flat. It's cyclical.
Yep.
So no, I very much agree with your analysis on the Melbourne market.
Yeah, I think it's about having chips on the table, right? And like maximizing your time in market and your exposure to the market. and knowing that, look, in real terms, your debt is going to depreciate in value and the asset is going to appreciate, and you need to focus on that return on equity, right? And just, maximize your holding time.
So I look, and I do ask all of our guests this, and it's not to be a bummer, but there are a lot of people that say, look at the property market, it's come and gone, it's too late, should have done it 5 years ago, there's no point doing it now. There's going to be a ceiling on how much asset prices can keep going up, and they might be talking themselves out of investing in property. Has the property hit a ceiling? Is there more to go in the property world? Where do you see 2025 for property?
Yeah, I think we're at a really interesting part in the market. I think that the underbuilding has probably never been so bad.
Like undersupply.
Right? Undersupply.
Yeah.
And we continue to, every year we say, we're only going to have 200,000 people in terms of migration. We have 400, 500,000. And actually we're at a point in the cycle where rates are starting to come down, right? And just the direction change is a really significant tailwind because it makes a colossal, and if you look at and you literally track interest rates and when they start to come down and then when you get the most significant gains, it's at that level. And the reality is people often question property prices or asset prices, but the reality is people can afford it, right? You look at mortgage arrears rates and what have you, we don't have a lot of the problems that they had in the US and
in 2008. Which is a mind-blowing thing because you are very right, because people say, well, the asset price is so considerably high and it's ahistorical, but those basic economic indicators on the interest rate side, on the migration side, on the supply side, all point to prices will keep going up. And you're totally right, which is the function of high interest rates in terms of correcting asset prices being too high. You're meant to trigger more sales. You're meant to trigger mortgage stress. Now, I'm not saying that this was the function that the RBA chose because there was more reasons for high interest rates than Australian property prices, but just when you're looking at that basic cause and effect of why one would increase interest rates in the face of a high asset class, it is to decrease that asset class, the price of it. That never happened, and the data showed that the amount of people that had to sell their property because of mortgage stress was pretty much unchanged year on year. It didn't do much, which is quite interesting.
Well, I think one of the interesting things that a lot of people don't really think about too much is it doesn't actually matter what the value of every house is today, right? What matters is what's everyone's cost base? What do they pay for it? And then how much of the market is transacting in any given year, right? And generally you have about 2 to 3% of the market that transacts in any year, right? So it's really not a lot of houses, right? So if you think about 2 to 3% on, say, a suburb where there might be 1,000 houses, you're like, okay, so 20 to 30 properties are going to sell in that suburb. So the question you've got to ask yourself is, okay, so for the 20 or 30 people that are going to, for the 20 or 30 people who are going to want to buy in that suburb, what does their balance sheet look like, right? Where are they coming from? How much equity do they have? And what's their income, right? Because, you're not dealing with an average, you're dealing with a tail end because not everyone is buying, It's only the people who are doing really well for whatever reason, whether it's they're in a great position with work or whether they've, managed to have some success previously in property or otherwise or in business, or maybe they're moving from another part of the world and they're bringing some money with them. So you're really only talking about a very small fraction of the market at any point in time that has paid whatever the price is, right? And and generally their balance sheet is going to look very, very different depending on who they are and where they're buying.
Very interesting. And yeah, I totally agree with that. And going back before to the undersupply, I heard I was having a chat with someone about this, and they were looking at the average price of construction for a new home, which is around the $500,000 mark. And if you were to buy, say, a land and building package, and so you'd pay 300-ish for your land, and which are obviously out of urban areas or regional areas, you're talking about $300,000 for the new land package, $500,000 for the build package. So sum total is going to be about $800,000. Now that's obviously before any transaction costs. That's before LMI. That's before stamp duty, etc. Now the interesting thing with that is more expensive than established homes in outer urban areas. So it is more expensive now in a lot of these areas to buy and build than to buy established, which is a very perverse incentive. I mean, perverse as in reverse incentive, which is your usual expectation that you're going to a new area, you're driving supply, you've got a new area gazetted for rezoned for construction. You're building the house yourself. You should expect that to be cheaper than the already established houses because you're incurring the risk, you're incurring the cost, you're incurring months or potentially years of not being able to inhabit that. But it is significantly more expensive than the already established dwellings, which shows that chronic supply shortages and undersupply is going to be a function of our market for years and years and years to come. And I don't really see there being any way, unless you have some new era of global prosperity, I don't see it becoming cheaper.
Well, yeah, I think you're right. I think that it's probably a function of the fact that it's just been so hard to build, right? And it's been so hard to deliver new stock, right? That people pay a premium for a turnkey solution. If they can walk into a new house where they've got everything, sort of in a nice format and how they like it, they're prepared to pay a premium because they don't want to go through the headache, right, of that. And that is an opportunity for investors as well, right? In the sense that, yeah, there is starting to, and this is property, it goes through, like you said, it's cyclical. It goes through cycles. And basically, prices move. They might stay flat for a very long time, and then they move up slowly to a point where suddenly it's economical to do something, where it's economical to buy that land, build a house on it, and you're going to make a profit.
Now, we were focusing on, we're looking forward in the crystal ball as to what the next 12 months is going to be looking like for investors. Now, talk to us. What opportunities do you reckon there are on the horizon? What are you seeing some real wins from your clients, from your network in property? What opportunities can people grasp in the next year or two?
Yeah, I think there's a couple of things that are kind of more macro, and then there's a pretty interesting opportunity that I'll talk about as well. I think the macro thing is really around like the undersupply and the fact that rates are starting to come down and migration is still really significant. That's going to be a tailwind, which I think is going to lift the market, generally more than what people have expected and priced in. But one really interesting development just in New South Wales recently was a couple of weeks ago. The New South Wales state government announced basically a new policy around medium density development, which has been contemplated at different stages for a really long time. I thought this was going to happen years ago, and it's come through, and they've really done.
So what's the policy?
So basically the policy. So it talks about the missing middle, right? Where for a long time, people have only thought about meeting our housing targets by either building out or building up, right? So urban sprawl, essentially, or concentrating around, say, train stations. Whereas, there's a lot of houses on 600-700 square meter blocks of land, which could easily be a duplex, right? Or could easily be a couple of terraces, 2 or 3 terraces. Or you could easily get like a 4 to 5 story flat building on like a larger side. But under the local councils, I think only 2 out of like 33 councils or something like that in Sydney could you otherwise do terraces, right? It's so yeah, it's so basically what the state government has said is they've come out and they've said, well, you know what, if you fall within these zonings, and you've got this minimum lot size and this minimum frontage, then you can do medium density development, so townhouses, duplexes, or even apartment buildings, through a complying development in a way where you can just bypass the council regulations, right? And it's not, I don't think that that's something that people need to, because a lot of people will hear this and hear, and they go, well, you know what, I'm not a developer. I don't really, have the appetite for going and building right now or the cash, right? But that's going to create a significant amount of land value in a lot of these areas.
100%.
And how the government's gone about it is super interesting. They've basically gone out and they've identified in New South Wales 171 local town centres that they believe can support medium density by virtue of the fact that it's in a short walking distance to a full-line supermarket, that they've got transport, in close proximity that can get you into a major working hub, and that they've got retail infrastructure and amenity, right? And so they've really earmarked like all the key areas that can be key growth areas. They've done literally the homework for everyday investors, where investors can go and look at a map of all of these areas and say, well, you know what? Wow, this is one of those areas. This section within it is identified as a low to medium rise, sort of rezoning possibility. And they can buy that knowing that they've got long-term potential of suddenly being able to do a duplex or terraces on a site that previously there could only be a single house.
And this goes to your point about number one, potential. It's an opportunity that, in the long run, with that kind of the buy and hold philosophy, the acquisition philosophy, and not just selling it once you've realised some element of capital gains, that you might not have the cash right now to do it, but 5-10 years, it's going to be a very different story. That you've now got an in-demand area, a bustling area, an area which will be a hub for families, for businesses, where people want to stay where they grew up. And now you've got this opportunity to put a townhouse on it or a duplex. Now, what role can Futurerent play in that?
Well, I think often in being able to move on to these opportunities and grow your portfolio, you need access to capital. You need, to be able to unlock a couple $100,000 from your property portfolio to give you the deposit to buy your next property or to take advantage of whatever opportunities you have. And we allow people to do that in a way where it doesn't impact their credit score. They don't need to refinance, don't dive into their personal finances. It's a really transparent, simple process. So we're really just about empowering and helping investors helping them do more with their property portfolios, helping them build their property portfolios and create wealth over the long term and stay in the game for the time that it takes for them to fully bake the cake and get the net asset position that they need.
Now, you've got the ebook, which is on your website, which is...
Yes, so futurerent.com.au, and we have a
forward slash SPI.
Makes
it easy.
Yeah.
You made it too easy. And you've also got another announcement today, which is a discount for our listeners.
Totally. So any SPI listeners will get a $500 off. And then we've got an ebook there, which contains some more information about this sort of power blueprint for building a portfolio. With some info there on some, clients and real examples that people can kind of really wrap their heads around in more detail.
Mate, it's at everyone's fingertips. There's no excuse not to know anymore. It's right at your fingertips. Now, mate, I think that is all we had time for today. Thank you so much for joining me on the SPI show.
Thanks so much, Liam. Pleasure.
And do go and visit futurerent.com.au if you do want to download that ebook and get that $500 discount and reach out to Godfrey's team. But that is all we had time for today. It was Liam Garman and Godfrey Dinh, founder and CEO of Futurerent. And we'll be back at the same time next week with another episode of the SPI Show. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.